Welcome to the 51st installment in Trading Strategy Guides Trading Education Series. Today we're going to talk about dun 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 money management. Wait for it. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment in our Trading Education Series. Okay, hopefully some of you have actually lasted past my announcement of today's topic. I know money management is not as shiny and exciting as day trading and scalping, but it is the most important facet of trading. If you want to be the chihuahua of day trading, always aggressive, always moving, always entering and exiting trades, and you want to actually make money doing it, you have to have an intimate understanding of money management. If you don't manage your risk properly, then trading will end up just being a hobby into which you continually have to pump money. Take a few minutes to understand how to do this. Billionaire hedge fund manager Paul Tudor Jones has once said that in this business, you need to see yourself not as a trader, but rather as a risk manager. There are hundreds of different ways to manage your risk and manage your own money, and it all really comes down to preference. However, you need to have some sort of money management system to be profitable in Forex trading. Believe it or not, this is probably the most important video in this course because you need to manage your risk to be able to have success. If you manage the risk, you have an excellent chance of making money in the Forex market. Basically, money management will tell you how large your position should be, but it will also tell you how much money you can make or lose at any given time because you've already estimated your risk in advance. Proper application of the principles taught through this video will make the career of a new trader. However, not following any money management principles will break the career of a new trader. The good news is that it's easy to understand, as there is nothing really complicated about money management. Money management is a phrase that is kind of a basket term for several different things that we look at as traders. We can basically break money management into 4 items as follows. Number 1, expectancy. Number 2, risk planning. Number 3, stop losses. And number 4, position sizing. Let's talk first about expectancy. Okay, here's a little warning. We're about to get a bit mathy. I apologize to those of you who are not mathy. I'm going to try to keep this as simple as possible, but there is some math necessary to understand money management, so you really need to tough through this part. The best traders in the world only get about 50% or even less of their trades right. The difference is that they only take trades that have a much greater reward compared with the risk taken. In other words, they have a positive reward to risk ratio, which leads us to expectancy. Expectancy is one of the most important factors in your success as a trader. In simple terms, trade expectancy is the average amount you can expect to win or lose on each individual trade. Let's take it one step further and see how to calculate the expectancy of your trade system. Expectancy equals the probability of a win percent times the average dollar win minus the probability of loss percent times the average dollar loss. For example, let's assume that our average trader Joe has figured out he wins on average 45% of the time, and on average that equates in dollar terms of about $600 per trade. But at the same time he loses 55% of the time, which on average we'll assume translates into $250 loss per trade. So what's Joe's expectancy? As you can see, Joe has a positive expectancy, so even if you produce losing trades 55% of the time, it might be frustrating, but has a positive expectancy, which means it will make money over time. This doesn't necessarily refer to planning your trade, which obviously needs to be part of your analysis and trading plan, but we try to plan our risk. This means that we want to maintain consistency with the risk we take. If you're consistent as a trader, that's one of the biggest hurdles that you can overcome, and it can be done right from day one if you're thoughtful about it. Essentially, planning your risk refers to how much of your trading account or portfolio you're willing to risk. So the next logical question should be, how much should I risk? Well, ultimately the answer to this question is a personal preference, and it comes down to your risk tolerance or ability to take pain. However, professional money managers recommend not risking more than 2% on any particular trading idea. It's not uncommon to see aggressive traders risking in the 5 to 10% range, so their risk tolerance is much higher. But plenty of traders stick to the 1 to 2% risk per trade of their account balance. One of the things you'll find in common is that the less you risk per trade, typically the more positions you're able to take at any particular time. However, if you have more at risk, you will inherently be inclined to take fewer trades. The risk per trade is something that you'll probably begin to refine over time, but don't try to ramp it up too fast until you've got some good trading experience behind you. Here's how to determine the risk dollar amount. For example, if your account balance is $10,000 and your risk tolerance is 2%, your dollar risk amount is $200 per trade. We now know that if the trade goes against us, the most you'll lose is $200. This will help you manage the mental part of trading and help you deal with the stress level because you already know in advance how much you're going to make if the trade goes in your favor and how much you're going to lose if the trade goes against you. Having a stop loss in place to protect you from catastrophic losses is very important. A stop loss is not arbitrary, but it's based on a specific price point that will prove you're wrong on your trade idea. For example, if you have an entry opportunity at a certain point and you know that the market is volatile and it could move against you, you have to determine at what point your analysis will be wrong. Is it 50 pips from your entry level? Is it 100 pips from your entry level? The answer is that the stop loss will vary based on what your analysis is. What is important here is that when the unexpected happens, you have an emergency net that catches your money if such a thing occurs. So, you don't trade without a stop loss. You never trade without a stop loss. Always remember to protect your bottom line and honor your stop loss because the market will be here tomorrow and the next week or month. And remember my trading maxim, there will always be another trade. Also remember my other trading maxim, your first job is to protect your account. Position sizing specifically refers to how much you should risk or how big a particular trade should be. Is it arbitrary? Or should you always be buying 5 lots or 1 lot? Well, there are several ways you can determine how big that position should be. It all comes down to the underlying principle of money management, which is what you can do to make sure that you're as consistent as possible. It's entirely under your control to be able to accomplish this particular objective. In order to be able to calculate your position sizing, you'll need to know 3 things. Number 1, your account size. Number 2, how much of that account you want to risk percentage-wise. That's exactly what we examined in the risk planning section. And number 3, the amount of your stop loss. Now from here, calculating how much we actually want to risk is quite simple. So let's walk through that calculation. For the purpose of this example, we're going to operate a fictional account size of $10,000. Let's say that our risk tolerance is 2% per trade, and based on our analysis, we figure out that we need a 50 pip stop loss. The basic formula for calculating your position size is this right here. In our case, the position size would be 4 mini lots. You see, that was easy. What we have accomplished is that we're not unintentionally or erratically trading too much in any one particular trade, or potentially just as bad, too little on any one position. You'll never know which of your trades will be good and which of your trades will be bad in advance. So position sizing will help you be very consistent, and when you're making your trading decisions, you're much more likely to take a trade with a position size that is consistent with your risk tolerance and with your market analysis. Money management is one of the most important parts of your trading activities because it will ensure you're going to survive through the ups and downs of your trades. Your number 1 priority as a trader should be capital protection because profits take care of themselves. The main advantage of implementing risk parameters into your strategy is that it will allow you to be in control of your emotions because you've already determined how much you're going to lose before jumping into a trade. Money management is going to allow you to trade in a smart way and give you the flexibility to choose how much you're willing to risk and how much you can get out of each trade. And that's it for today's video. I mentioned earlier that I would tell you about the Comcash Alerts app. With this app, I can share all of my trade setups and my trade tracking and even chat with you guys and answer questions. The trade setups from the TradePicks videos are available on the app, plus the other trades I take personally every week. Right here is a screenshot from late Tuesday of the chat screen with my trade notifications from the weekend. The Comcash Alerts app is available for iPhone, Android, and desktop browser. Click the link in the description below for more details. And come back Friday for my strategy of the week and next Monday for my trade picks. My videos come out at 3 p.m. New York time on those days. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash the like below, subscribe, and hit the bell if you want to be notified of our videos in the future. Have a great Wednesday, and I'll see you on Friday.